people actually love overdraft. It's just they hate paying these super high fees. I mean, who wouldn't want the flexibility to go get some extra money before their paycheck date at a very minimal or no cost? And that's what we brought to market. And that's really what we unlocked that other neobanks had not. And that's how we grew so fast compared to them early on.
Thank you, everybody, for joining me, and welcome to the Restive Perspective. I'm Ryan Falvey. It's my first time hosting the Restive Perspective. Normally, my partner Cameron has taken lead on these things, but I'm excited to lead this process and this podcast for my very first inaugural one. And I could think of no better guest to kick things off than Jason Wilk, founder and CEO of Dave. I was lucky to have been one of Jason's first investors years ago now, and so I've watched up close as he's turned a simple, but I think very profound idea around overdraft fees into one of the most recognizable names in fintech, a company he took public. And then while in the public markets, really has transformed the company into one of the leading, in my mind, kind of technology firms in financial services over the last couple of years. It's been a wild ride. The company was probably one of the fastest companies ever to go public from launch. Had a very difficult, first year or so in the public markets, really lost about 90% of its value, and then came really raging back over the last, 24 months. And in large part because the impact, in my opinion, of AI and kind of really some significant investments in technology. And so I wrote a paper a few weeks ago around kind of asking the question of, is Dave the first kind of AI fintech company? And so I wanted to bring Jason on the podcast to talk a little bit about that thesis, give us his view on where he sees the market evolving, and really talk through what has been really an incredible ride over the last several years. And so Jason, just to kind of kick things off, why don't you give us kind of the founding story of Dave? I know you've told it a million times, but when you started this, what were you really looking to solve, and kind of what was that personal kind of aha moment that led you to start this business?
Well, Ryan, great to be here. You've been a fantastic investor back since the seed round of the company. You convinced me to go into your fintech incubator back when we were just getting off the ground. So you've seen the company truly since its infancy. And I think the backstory. The company name stands for Dave versus Goliath. We were a very small but mighty team going after the large incumbent banks, trying to disrupt what we thought was predatory overdraft fees. When I was going through college, the pain of overdrafting my account on a cup of coffee, getting a bag of groceries, and paying a $34 fee per instance, so up to $100 per day of fees when you're making very little money as a college student or a struggling entrepreneur, those really add up. And after I sold my first business and had a little bit of money in my pocket, I wanted to go after a much bigger problem. And fintech was just ripe for disruption. This little known company at the time came out called Plaid in 2015, which was the great enabler for us to connect consumer accounts to financial institutions and get access to customers' financial data. And the only company I'd seen that had come out before Dave was Acorns, and they were using financial data to look at your transactions to round up for investing purposes. I'm like, wow, if we could use that same technology to look at someone's transaction history and verify sort of their payroll and employment information, you could underwrite that. Because that was my pain point with banks early on was, hey, I'm a great customer. I've been with my bank for 10 plus years. They know when I get paid. They know I'm a low risk user. Why charge me such high fees? And so the first product came out for Dave, which we call Extra Cash, giving people access to what was the amount of money I needed at the time, which was $75 of credit to go buy gas or groceries. And we issued that credit entirely for free, monetizing purely off of people's willingness to tip Dave, as well as people willing to pay for speed. But you could come in the door, apply for credit with Dave, get approved instantly based just on the merits of your cash flow data. No credit score, no credit check, no late fees, no interest, truly free credit. And if you're willing to wait a couple of days for it. And that's how the company took off with the early thesis that we built to acquire customers really quickly. People were very upset with their ability to access inexpensive credit for everyday essentials.
And I remember that those really early days, and I guess a question for you, at the time there were other companies that were doing kind of, earned wage advance products, and some of them were pretty far along. Um, why did you see the overdraft protection piece of it being like fundamentally distinct from, hey, I'll kind of advance you $100 or a couple $100 on your next paycheck? Like, why cleave so tightly to that idea, the overdraft protection piece of it, rather than just say, hey, this is basically an advance on money I know you're good for? I mean, because you never really did kind of just general like money when you need it. It's always has been kind of like, hey, or at least early on was very much like, avoid overdraft fees.
Well, there were some companies out there in earned wage access really partnering with employers to look at your timesheet data to give you what you had effectively earned that day. But that I felt was a very different approach to our business. We never really thought about earned wage access being the competition today. We looked at incumbent bank overdraft being the true competition. That was involved in all of our marketing. We were the first ones really to leverage the cash flow data to underwrite accounts. I mean, everyone that predated Dave was just using, again, timesheet data and trying to unlock truly earned wages. And Dave was actually willing to advance you your upcoming wages that you otherwise needed to go buy those essentials. And so when I think about our early competition, I looked at the likes of Chime, Bank Simple, companies out there that have been in market with a neobank for many years prior to Dave, but their approach to overdraft was no overdraft fees because we don't offer overdraft at all in our accounts. And that was the big insight we brought to the market was people actually love overdraft. It's just they hate paying these super high fees. I mean, who wouldn't want the flexibility to go get some extra money before their paycheck date at a very minimal or no cost? And that's what we brought to market, and that's really what we unlocked that other neobanks had not, and that's how we grew so fast compared to them early on.
And that's an interesting insight. And then I guess one I've never heard you make, but did you see that people actually liked overdraft? Like, do you think that if overdraft was just a free feature that people would be using it and seeing it as a feature, or was this something that people were kind of accidentally doing?
If you look at how the lower income or paycheck to paycheck consumers are utilizing overdraft, they are knowingly overdrafting their account for accessing short-term credit, albeit at very, very expensive rates. When you think about an annualized rate on $100 of overdraft in one day, it's like 20,000%. But people love the flexibility of taking their account negative. And so if overdraft were free, Dave never would have been a company because it never would have had the pain point required to want to start the business and have the bone to pick with the banks.
When did you kind of realize that insight? That people liked overdraft. Not that like this was a necessary evil, but this was in fact something that people might want. They just didn't like what they're being charged for it.
I didn't need a lot of validation because I was the end customer. It wasn't like I went around and like did a bunch of market research to figure out what's the biggest pain point in banking. I knew it because I was so upset with the fees. So I didn't have to go spend a lot of time thinking about it. It was more so there were so many tools that were not available for us to build this business early on. And so that was really the challenging part was being a non-fintech person to try and learn the industry, take a crash course in fintech and build the business. I knew if we could get it right, we would acquire customers at scale. And that played out very quickly with our CAC being nearly zero when we launched the business, and we were scaling very quickly.
You said before, I mean, you realized you were onto something very early in the company's life cycle, I think. Like how early were you? Were like, hey, this is huge.
It was pretty immediate. Once we launched the business, we actually, before we pressed go live in the App Store and started marketing the business, somebody had searched for overdraft in the App Store. They found our app before it was known. We didn't even know it was actually live in the Android store. Yeah. Somebody had downloaded the app, taken out a extra cash origination, paid us back, and tipped us. So like, wow, this is actually works. And no market education. it truly had some early on validation, which was great to see. And we've always had very low marketing costs since day one.
Yeah.
Our CAC in Q2 was $19 to get someone to open up a full on checking account, full KYC process, and compare that to the large banks that are well into the hundreds. Even our closest neobank competition, well over $100 to open an equivalent account.
I learned about Dave because someone at, I think, Google in the Android store had reached out to us because there was this product that people were using to borrow, and they were like, is this good for consumers? Like, is this actually something that we should allow? Like, should we think about this business? Because it was taking off so early that it just kind of started going. What was I feel like I remember the CAC in those early days being like pennies, like basically not anything.
It was never pennies, but it was underneath 10. I think it was under 5 for a good amount of time when we first went live. And
for like years.
yeah. Yeah.
Yeah.
And when you think about why that exists, so still today, a third of our acquisition is from word of mouth. So it's just this really strong
Yeah.
referral product. And that's not paid referrals. People tend not to take a referral link and go put it on their social media, but they do tend to tell their friends and family about this product that helped them get out of a short-term emergency. And because we're using that cash flow data to underwrite consumers, we'll give you credit the same day that you join. I mean, the speed to value is literally 5 minutes from seeing our ad to having money in your pocket. And that speed was so far different than the way incumbents and even our peers treat overdraft or short-term credit that require lengthy and cumbersome direct deposit. And it's our view that people are not willing to switch their entire bank account for access to credit. And because of that, the TAM of people willing to connect a bank account far larger of people willing to do that activity. And so I think that just speaks to why our CAC is so much lower, so much lower. We've also just developed a great brand too, Dave.com. We spent a good amount of our seed check to acquire that domain name. We have a really recognizable mascot. We've invested in a lot of equity in our go-to-market brand message around getting up to $500 in 5 minutes or less. And then again, the speed to value driving the heavy word of mouth.
When did you realize? So the product had almost immediate kind of product market fit. I remember that early on there was less immediate product market fit on the investor side. I remember like that definitely was a little bit like trying to get that story, especially kind of the seed Series A. It didn't immediately resonate. And certainly I think a lot of the investor base kind of was like, well, this category has already kind of come along. There was that comparison, the earned wage access businesses, probably questions around like, is overdraft like even a thing? I mean, remember those conversations. But like, when did you realize that this was like going to be a fast capitalization company too? In the sense of like, you got from seed to basically going public. I mean, what was it, like 5 years?
Yeah, 5+ years.
Like the Series B was 2.5 years into it.
Yeah, it was fast, but the early days were difficult. I mean, we're going into a category. There's never been a successful neobank. You had Bank Simple that was out there that largely was an asset sale. Chime was still very early on, had not found their product market fit yet. And then you also look at how companies had fared in the public markets who are in any kind of lending capability that were not doing well. So it was a hard story to go tell investors with fintech being a very nascent category. And especially when you layer in that we're offering up to $75 of credit, people didn't understand, one, overdraft fees. Most venture capitalists have never overdrafted their account ever. And then second, to think that at that time, Americans needed micro lending, a $75 credit did also not resonate. And so just me really trying to talk about my personal story. It took us 120 meetings to close the Series A. And ultimately, the guy who ended up writing the check for the Series A, he only did it because one of our early investors gave us an amazing reference. This particular investor had no real knowledge of fintech and wrote the checks. He liked the team. Now, usually Series A, it's still largely based on product market fit and liking the category, not based on team dynamics. And that's how we ultimately only had one investor write a check for the A. But the very next round was at a $1 billion valuation in our B, when fintech, people finally had an appreciation for scale and how well these companies were doing.
Well, even that, I remember you had this amazing story when you were raising the Series B, um, where I think you went to you were at this like some fancy party in LA, some celebrity was hosting, and it was like this unbelievable kind of like spread. And someone was like, can you believe that people have like these overdraft fees? You ever heard of this? Like this is like just like unbelievable that overdraft fees like even existed. Like that was even like a thing in our economy. Just because of like who you were, of like just how investors are, like just the socioeconomic background of the average venture capitalist, like just didn't overlap at all with the product and with people you're serving.
Either investors didn't know. We also met with a very well-known venture capitalist who back-channeled to our investors saying, this customer base is too poor. It's not interesting, but just no one really got it. But if you just look at the big banks are structurally disadvantaged to provide great services to customers that don't make over $100,000 a year because of their infrastructure costs, their heavy bank branches. You listen to what Jamie Dimon is saying, they're doubling down on bank branches. And so when you think about their ability to recoup their cost per year on a basic checking account, it's upwards of $300 per year. And when you think about Dave, putting the AI underwriting aside, because we are digital first, we're using AI to build our business. We don't have any bank branches. We have a cost to serve that's a tenth of the banks. And so I can offer better products at a fraction of the cost forever. I mean, I just think that's just a great place to sit within this industry.
I would say, how did that, just, I mean, kind of draw on two threads here, and maybe it's a good transition to kind of where the company is now, but like, how did that early experience, it took 120 meetings to get the Series A done. The Series B was done at, at the time, a really very high valuation, like on like a notional amount of money. And then you didn't raise any more money really until you went public. Did that early experience of like all those calls of hearing like well-known investors back channel, like kind of say, hey, these people are too poor to serve, did that affect how you thought about capitalizing the company?
In many respects, because of how difficult it was with the venture community, when we had an opportunity to go public, albeit early, we thought it'd be a great chance to just capitalize the company to get enough money to never have to go raise money again. I mean, it was always a battle to go and, go up to Sand Hill Road and take the 100 meetings. And we figured if we could free ourselves of having a big pref stack in the business, we're very fortunate in the sense we only raised $60 million of primary capital to date. And so to wipe out the pref stack, get a big slug of common equity into the business, and whatever happened in the public markets, we were just willing to ride the storm because ultimately we had a long-term view on the company. Obviously did not predict the market cap would go down 98%. That was not very fun. But if you just believed in the vision that we could get into enough customers to get the company to profitability, which to me was not a big bet. We were acquiring customers at scale, at a low CAC. Like, we were going to get to that number, but investors basically wrote us off to zero because they didn't think we had enough capital to get there. And now we not only didn't have enough, not only have enough capital, but we have excess capital. We're buying back our own stock at this point. One of the youngest companies to do so. We deployed, I think, 45 million of share buybacks just this year alone, and recently announced expanding that to 125 million.
Yeah. Well, let me ask you then, because if I had, when was a low point in the stock? Like mid 22?
No, it would have been in 23 was the low point. So
Really?
I think my son was born on the day of the stock was the lowest. It was like $4 and something in change. I think it was May 2023. That was the low point.
That was a low. It was a good, lucky addition to the team there.
Yes.
Yeah. I think if like someone had asked you like kind of that mid 23, early 23, like, would you have like regretted going public?
Well, no, not going public itself, but going public at the time we went public. I mean, had we gone out when the rest of the pack went out, sort of, late 2020, early 2021, we would have been so well capitalized. We would have been able to build our analyst coverage up. We would have probably done some follow-on capital raises to bring in some of the bulge bracket banks. It's just the fact we went public January 2022. We raised money from Tiger Global in our PIPE round, and they were an unrestricted investor. And we had hoped, obviously, they would support the business through whatever downturn there may be, but they were completely sold out of the stock before our lockup expired. And when you're dealing with such a thin cap table that we already have with a bunch of investors that are so up on their initial investment, paired with the fact we had no research coverage, and then fintech fell out of favor when interest rates went up, it was the perfect storm of terrible to where the company was just stuck. I mean, there was no way for us to save the market cap. There was no bid on the stock. At any given day, the company was trading about $10,000 a day of notional value. So we were told there was really nothing we could do. But the one thing we had in our corner was we had enough capital. I mean, we were trading for below cash value, but we had a lot of conviction that the company was still improving. And it wasn't like we had to cut all these costs or do rifts to get to profitability. We didn't do any layoffs at the business. We just kept our heads down. We kept the team motivated, gave people performance stock awards to incentivize them if the stock were to go up to certain higher levels. And we just executed. And it's been such a rewarding experience to see the team deliver on the targets that we set out. And I think really when the company turned around, we started to develop a very clear investor relations story around once this company reaches 2.1 million paying members. I think at the time we were probably 1.6 million members. But once we hit 2.1 million, every incremental dollar that we generate is going to turn into pretty much EBITDA from there. And that turned out to be true.
Yeah. And so just to make sure we can kind of catch the listener up, like basically company goes from, effectively zero to 4 billion from its inception in 2017 through listing in like early 22. Yep. Goes from 4 billion down to basically like 100 million,
50 million,
like EV, or market cap by early 23. And then since that low point has been, and really throughout, like really concentrated kind of 2024 and through up into this point, gone back to today, you're at kind of, about 3 billion, right? Of kind of market cap ish range. And so you had this just incredible, like you rise, collapse, and then kind of like rise back. And I remember to second your thought, I talked to a banker in, I was late 22, I guess. And he was like, Jason should really just sell this thing, like for whatever it gets and just start a new business. Like it's going to be a decade before it comes back. I mean, just like, it was just kind of like been left for dead in the public markets. And so like, you should just, basically like give up and just like find something new. And I think what's kind of interesting is, as an investor in the company, I almost wonder if like that experience coupled with like going through that experience as a public company was better than going through the public experience as a private company, because you had like instantaneous feedback from like a completely apathetic investor base over what they thought of your business model and like the story and where it was going. And like that feedback was very negative. And you think about like the private companies at that time, there were a lot of companies that, kind of high watered on evaluation in late 21 as well. But then spent 22 and 23 kind of just assuming everything would come back and really not doing as much to invest in the product, invest in the people, invest in a longer term strategy. And so I wonder, like, obviously that was really difficult, but do you think you're better off now? I mean, I think the answer is yes, but maybe so like, why are you better off now having been public during that period rather than if you were private?
Well, first of all, I think if we had stayed private, we would have definitely needed to raise one more round of capital because we wouldn't have raised all the proceeds from the IPO. And so depending on when we were to have gotten that round done, that could have been with, some pretty tough structure. You've seen a lot of guys do some really unnatural things to raise capital during this, strange growth trajectory timeframe. And so I think from that perspective, the fact we got to raise this capital, even though we went through this winter on valuation, we still net ended up in a great place where we have no preferred equity on the cap table whatsoever, no debt on the company. It's just a great place to sit. So it just depends, really depends on the timing of which we would have gone public, to give you a real answer to that question.
Yeah. I guess, so to kind of pivot on the AI piece of it, I wrote a paper about a month ago, kind of came out this summer, this kind of basically are asking the question, is Dave in kind of AI company? And, obviously, as an investor, I'd love for Dave to be valued like an AI company. So I'm trying to have this be too kind of self promoting. But what kind of triggered that for me was your earnings in I think it was a Q1 earnings this year, with the ones that kind of came out in May. And they were just kind of spectacular across the board, and had been building on increasingly improving earnings performance going back for really the last year, where your losses are going down, the provisions for losses are going down, the number of customers is going up, the loan size or the advance size is going up. I mean, it just seems like everything was breaking in a really positive way. And I remember like last year was the first time, I don't know how long you've been talking about Cash AI and the kind of the AI underwriting tool publicly, but I think I kind of entered my consciousness, sometime, late 23. And, as a VC, people are always talking about AI that's been doing this for years. And so you're like, all right, whatever. And I started thinking there's really no way the performance could be improving so much unless they were actually getting some sort of competitive advantage there. From a technology standpoint, because it's outpacing, your competitors, quote unquote, and kind of the market more broadly. And so I guess question for you, one is kind of an open-ended question. I mean, do you think you're an AI company? I think the first part of it. And then second am I right in the sense that you did do something in, say, 22, 23, as you started seeing these breakthroughs in kind of all these LLM models, to really put yourself on the cutting edge of that trend?
100%. I'd say at this point, we are an AI first company. We were not when we first launched the business, but if you go back to 2017, we launched the business with $75 of credit limit. We're now offering up to $500. And that's only a result of early investments in machine learning back in 2019 to basically say, look, rules-based models got us to where we are in underwriting. We had 10 simple checks in place for people to get approved for credit. But when you think about AI in the context of cash flow-based underwriting, you're analyzing billions of transactions. And so AI is the perfect tool to find commonalities of splitting good and bad risk by things that a rules-based model can never pick up. Times a day that you get paid, times a day you shop, where you bank with, types of ATMs you go to. I mean, there's so many inputs now that we can put into the model to assess. And then when you marry that with short duration, the AI gets to tell every 10 days whether or not the new features that put into the model actually were effective or not. So we've been able to take our loss rates from, I think, probably 5% back in 2019. Now on a 120-day basis, they're nearly 1%. And that's pretty amazing when you think about we are giving money to customers with zero credit score. We're not pulling credit whatsoever. And so it's largely a younger / subprime consumer. And so to have nearly perfect loss rates would never be possible without AI. Then I think that's like first and foremost how we should be seen as an AI company, because the rest of the stuff we're doing around AI, from sort of chat support to onboarding, like those are all like kind of table stakes AI capabilities, which are helping with operational leverage. But the real secret sauce is in the underwriting cash flow. And we have such a lead there, given we've originated our extra cash product 150 million times now. And so you think about solutions getting smarter and smarter as you progress, that's a great place to be.
Why? And so your date there is one kind of question mark. I mean, you say in 2019, you really started investing in AI. I mean, we've obviously seen kind of huge breakthroughs in foundational models really over, really since 23, and they've kind of accelerated. Are those breakthroughs translating to your business? I mean, like, I guess would help me understand like the relationship between kind of where the cutting edge of, kind of, LLM based AI models is and the application of it into Dave's kind of core business.
These are all homegrown models, so it's not like GPT-5 comes out and there's some step change in our business. I think where that will show up is in terms of sort of better customer support. But when we think about our own models, that we're not leveraging anyone's models other than ourselves, and so have not seen that necessarily having us track with progress there, given we have our own trajectory.
Are you affected by improvements in just like hardware and just like broader performance improvements in kind of the AI space?
There are. I mean, for us to even thinking about the ability to uh, process underwriting to send proactive alerts to people needs sort of more GPU coverage to even enable that. So yeah, definitely the hardware improvements have been allow us to crunch more data faster, which is just better in terms of marketing and just a better user experience to be approved for credit even faster than previously.
Do you have a sense of like how much of a head start you have over a competitor? I mean, I think if you have improvements in technology here, certainly you're gonna have companies that are gonna start getting, more and more data points. Like, and I know you're a really competitive person generally. Like, you're do you see yourself out in front of the race and like you need to run faster to stay ahead, or you think like you're neck and neck with your competitors? Like, how do you visualize where kind of Dave is vis-a-vis its competition in deploying AI into the credit underwriting, into the credit process?
Well, I think when I think about our competition, so from the big banks, miles ahead on the underwriting component. When I think about the Chimes and the Cash Apps of the world, because we're leveraging external account data, not direct deposit inflows, I think we're miles ahead of them on that front as well. And then we can leverage this external account data to get ourselves into new forms of credit with longer duration and prove out the efficacy of our models there. Then we further extend our lead. And so I think we're really in a good position here with respect to competition.
Tell me what that means. Like, does that mean you're serving more and more customers? Is that you're giving them larger advances? Uh, I realize that the duration could grow with some customers, but does the duration grow as you add more like, or is this new products? Like, what does the revenue composition mix look like as you start to expand these solutions over the next like, several years?
Well, it's going to be more ARPU as a result of shipping more products, but it's also
Mhm.
going to show up in more originations per user. The better the model gets, the more extra cash origination volume per user we're going to get to. We're already up considerably year over year. We're at 206 is our average approval now, up from I believe 150 or something this time last year. So marked improvements there. And then as we can start to get into these longer duration products, you're going to see originations grow as well. So I'd like to think that Cash AI can be a great enabler for us to get into bigger credit limits and keep loss rates at or better from where they are today.
How has this affected your thoughts as like being the leader of the company? Like, like, I when you were starting, you talked a lot about like the brand and the bear mascot and the kind of getting that messaging really right to resonate with customers. As you talk about the growth of the business, you're really talking about the investing in technology and data and these tools. Like, what does that mean for you as like the CEO? I mean, are you having to change how you think about, hiring and incentivizing talent? Like, just walk us through like the effect that that's had on you.
Well, I think from a team perspective, we've really shifted our thinking from being a fast growing workforce back in 2019, 2020 to how can we build the best small team within fintech. And we've been 300 people now for several years. And I think because of the improvements in AI with respect to product development, we should be able to develop our near to medium term roadmap with the existing headcount that we have. I think that's pretty amazing. And so I think about just we want Dave to be seen as an elite place to work, and that's been a pretty big shift. An elite small team versus a again growing large company. And that allows us to just have longer tenured people you really know on your team, people that really know the product and the company well, and uh, using AI for them to just do more with with less is, uh, I think, to me, a great enabler of the company, and I think a motivating mission statement for the business too.
Is that enough people? Like, do you get investors? They're like, hey, there's not enough people at this company. Like, you should have more IR staff or more HR people. Like, I mean, that just seems like not very many people for a company that's doing hundreds of millions of dollars of revenue and growing so quickly.
You tend to not see public company investors pushing you to add more cost. I'd say that may be the very big difference between venture capitalists and public market investors. But yes, it is enough people. I mean, we are by no means starving resources to increase profitability. We truly believe that, building this elite team, we can actually do better with having less than having more.
So giving ahead, like, let's go out. Like, you've been public for like 3 years now, 3.5.
Yeah, 3.5.
It's been pretty a wild, like 3.5 year period. Where do you want to be? Like, when you look ahead, like you're doing like your 5 year, 10 year plan, like where do you want this company to be?
I think even if we could just keep our head down on the core business of offering free checking and a great extra cash product, the TAM is just so big. We're at 2.6 million paying members today. I'd love to see that number grow exponentially to where it is. I mean, if you look at the monetization we're bringing in just on that level of base, if we can get this to 10 million monthly transacting members, it's a massive business. So I want to make sure that we are best in class at what we do on those two products while layering in new credit adjacencies that can allow customers to buy things that they can't really do with us today. I mean, extra cash is an amazing tool for gas and groceries, but it's not great if you need to buy a plane ticket. I mean, who wants to pay back a plane ticket on your next paycheck date? And so I like to see us doing more for our customers. I think the more we do for them, the more shots on goal we have for them to think of Dave as their sort of primary account. And that's ultimately where I want to see us get to, is people thinking of Dave as their primary account. Doesn't even necessarily mean direct deposit, but it's the place that people are using on a frequent basis for their primary financial needs. And that can come in various forms. So that's really our goal.
Is there a company or a CEO that you model kind of yourself after? We think of like, hey, that's the type of firm I want to build over the long term.
I mean, I look at CEOs like the Coinbase CEO. I mean, I don't follow everything he
Yeah.
does, but I think the way he clearly articulates their mission, vision, strategy, and audience, I think are really clear ways to motivate the team, and just great sort of artifacts to have out there that you can point to for new people coming to the company, things you can consistently reiterate at company all hands. And so I respect that. And I think within fintech, Robinhood seems to do a very good job at product velocity. I mean,
Hmm.
something we are not jealous of, but I mean, certainly it's a model to follow to try and just get more products. I think Vlad said they have like 9 products now that are over 100 million of annualized revenue. Yeah, that's pretty impressive. I mean, we have one today. Hopefully we'll have several within the years to come. But yeah, I think they're kind of in the lead on. Uh,
It's interesting you bring up like Robinhood, though. I mean, it seems to me that you're building a very different business. I mean, it's actually probably much closer to Coinbase. Like, we are going to be the front door for crypto. Like, if you want to use crypto, you're going to come to Coinbase, and like we will make that your home, and like they're going to be synonymous for our customers. Like that resonates. And I think I'm sure Coinbase has all sorts of products and stuff now, but like I think most people would just see that as like, hey, this is an exchange. This is a safe place to go buy and sell. Probably Bitcoin, honestly, if you ask most people, like they would like this. It's the message. The message is very, very clear. And I think like you think of how he builds that. Like, I imagine internally, it's a lot of, we're going to compound. We're going to make this feature better. This feature better. It's just like it's a bunch of little incremental improvements. That seems so different to me than like how Robinhood presents itself as, like you said, high product velocity. They're going to be on a cutting edge. They're talking about tokenizing stocks. Like, they're doing a lot, but it just they feel different to me.
Well, I mean, yeah, the two different types of companies. I would say we are very focused on making two of our key products the best they can be in market, while expanding into new solutions. But I'd say where Robinhood, it's interesting. They're just customers are very open to new ideas and testing and trying new stuff. And
Hmm.
you don't really know. You can do market research till you're blue in the face, but the only true way to get product market fit receptivity is to ship product and see if customers like it. And so I think within fintech, there's so much to disrupt. And so I think the more you can do to test customers and try and find new pockets of growth, the better. And they're the ones doing it best in class in terms of getting things out the door to get people to test it.
Do you think you trust your customers more than maybe some other executives do?
Well, we have an amazing data set that most companies don't, which is access to the cash flow data. And so not only does that help me with my underwriting, but I can also see every fintech product my customers use. So I have a very good intel into what we should build next based on what my customers actually can show me that they like through their transactions. And that's an amazing place to sit versus calling up 100 users and saying, "Hey, what kind of
Yeah.
products do you use?" I literally know that at scale.
Do you think that that relationship of like, I'm your friend, is it like it gives you even more ability to do that?
100%. And I think when you can solve a real pain point for a consumer, especially with our extra cash product. If I can get you to work today, because I got to fill your gas tank, if I can put food on the table for your family within minutes of seeing our ad, I mean, that builds a level of trust that when we go ship new products, we get significant adoption of those. And so I think we do have a bigger license to cross sell and build new things for our customers because of the place that we sit within their financial life. And so that to me is why product velocity is so important, because I think we do have the ability to win market share with customers if we ship it.
Looking at where you're now, and like it's a comeback, but like I think as you said before, it's like not a full comeback. Like you still got to do more. But is there like is there like a point where you could wish you kind of go back to yourself at some point in this journey and like give yourself some advice or a perspective that you kind of wish you had at the time?
Well, obviously, if I had some insights that the market was going to fall apart, would have just approached things a little bit a little bit differently. I mean, we definitely had some opportunities to do a SPAC earlier. We felt we were being sort of responsible by pulling back and just, getting that
Yeah.
extra executive or two in the business, buttoning up this stat or that stat. But, that ended up being not the right strategy. I mean, the market truly did fall apart, and there were just too many not great companies that took advantage of the window that, kind of ended the party for everybody. And that was unfortunate because it really overshadowed great companies like Dave that had to just basically drive perfect performance to get back to where we are today. And that was not easy.
Yeah. Well, listen, you've always been kind of an inspiration to founders that we work with, and I've always enjoyed spending time with you and talking with you. So thank you for taking time of your day to do this with me. It means a lot.
Yeah, thanks, Ryan. Really appreciate you as an investor, and you've always stuck with us. You and Tom, I've always appreciated it.
Thanks, man. Great. Well, thanks so much to Jason for joining us on that session. It was really informative, and I had a great time chatting with him. You can see why I've always enjoyed working with Jason, and his perspective on the market and kind of vision for where it's going is really unique in financial services and fintech. And so we're thankful to have him as a portfolio company, and thankful to have him join us on the podcast. So with that, thank you for listening to the Restive Perspective. If you enjoyed this conversation, please make sure you subscribe on Spotify, Apple Podcasts, or YouTube so you don't miss future episodes. And if you want to see more of our latest content and perspectives on the future of financial services, head over to restive.com. I'm Ryan Falvey. Thanks for joining me, and I'll see you next time.